Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hey, welcome back to the Massive Passive Cash Flow podcast. This is Gary Wilson, your host. I'm glad you're back and listening with us again. We got a great show today. Jason Balin is on from my old stomping grounds, which is Maryland. So it's kind of neat to talk to guys from there and shoot the breeze about the old sports. If you're sports fans, remember, you got the old Colts, who are not there anymore, obviously the Ravens, but the Baltimore Orioles, lots of history, and just a fun place to be. So, Jason, welcome aboard, man. Glad to have you here.
Thanks, Gary. I certainly appreciate it. Looking forward to it.
Yeah. Hey, so what we're talking about, guys, is hard money lending today, and I want you to really listen and pay attention. And if you're not driving, take notes. If you are driving, you can listen to it again later. There'll be show notes. We're going to put show notes in when we put this out there. So, don't be dangerous, but there'll be things here that you're going to want to write down. I've met Jason before. I've been on his podcast. Another guy named Ian that's big in investing in the Maryland area. So, really good stuff for you to learn and write down. So Jason, if you wouldn't mind, share with everybody how you actually got into this. What was your point of inspiration, or what led you to this in this business?
Yeah, so absolutely. So in the early 2000s, I was dabbling along with real estate. I thought real estate was very intriguing, and I'd flip houses, buy rental properties. I worked as a mortgage broker as well, and I soon realized that flipping houses was not great for me. It was challenging for me. I didn't really enjoy it. I liked being kind of the deal junkie and involved in deals. I just didn't like doing the heavy lifting on the deals. So shortly after, in 2000. Actually, let me back up one quick story. That's a good one. I was working at a mortgage company at a time, just regular conventional bank mortgages and things like that. And the owner of the company was lending private money. I didn't know what that was at the time. I was younger. And I remember coming to him and being like, hey, listen, this deal looks like a really good deal, but we can't get anyone to buy it off our books. It's not getting approved by the underwriter. Like, what should we do? He's like, let me take a look at this. And he said, you know what? We'll do this deal. Tell the borrower it's going to be these terms, and I'll fund it out of my own pocket. And I'm like, what do you mean? And he was like, yeah, I'll just be the lender. I'll be the bank. I'll be Wells Fargo. I'll be Bank of America. I can be the lender on the deal. And I was like, that's something you can do? And he's like, yeah, that's what we do. And we have a whole portfolio of that. So that was kind of my first sign of private lending. And then fast forward a few years when I was doing, a good bit of house flipping. I'll never forget. I got money lent to me by a guy named Ray out of Texas, and I was flipping a house on the East Coast. And, it took us 6 months to do this flip. And at the end of the day, I was like, you know what? I think Ray's the only one who made money on this deal except me. And I was like, I don't like flipping houses. I like being on the lending side of it. So in 2007, my business partner, Chris, and I, going on, 16, 17 years now, almost, started a company called Hard Money Bankers. And we lend private capital to real estate investors all over.
Nice. It's so what obviously the economy's changed. You're back in the early 2000s. It was like crazy. I mean, everything was moving so fast. It was just insane if you were investing at the time. Then, of course, the recession hit, and unfortunately, some people got hurt, but other people made a ton of money again. It's just, but their rates can go up and down and fluctuate depending on the availability of money, and how much of that is affected by conventional lending. So when the conventional lender is starting to tighten the range, do you find that more people are coming to you, or is it, what kind of give us a little background there, how that affects your business and vice versa,
Well, so it's a good question, because I think a lot of folks don't realize how impactful conventional financing has in place. Because think about it. If you're buying a primary residence, typically you need to get a bank loan. And I'm not saying that conventional loans are the only types of lending out there, but it's obviously a big chunk. So if you're going to buy a primary residence, you are going to probably get some sort of bank loan on that. If you're a real estate investor, typically most real estate investors have some sort of leverage. And let's say you're buying a rental property, eventually you're going to need to refinance that rental property and get, a longer term debt on it. And again, that some people buy in cash, and I certainly understand that, but they play a big play related to, interest rates for the private markets, private lenders, hard money lenders. It doesn't really impact them all that much, but it does, like you said, it changes the market, right? If I'm going to do a loan for somebody who's going to fix and flip a property,
Mm-hmm.
Well, the end bank, and when I say the end bank, is like if you go out and let's say you use hard money bankers or another private lender to use capital to fix a property up, you're going to flip it to a homeowner. Chances are, when you flip it to that homeowner,
Mm-hmm.
they're going to need a bank loan. So it's something that definitely takes, you got to take in consideration. And the funny thing is it seems like across the whole country, the interest rates probably doubled over the last 18 months, and the market hasn't changed all that much yet.
Yeah.
Who knows if it will or if it hasn't, but it hasn't really made a gigantic impact, which is crazy. Like, one would think that, hey, if my affordability is significantly higher, the price of the property has to go down in theory. And that might come, right? Maybe that does,
Yeah.
maybe that doesn't. I mean, that's obviously a little bit different of a conversation, because there's still there's not much inventory compared to what we're used to out there, but definitely the cost of capital. And keep in mind, short-term capital,
Mm-hmm.
which in essence doesn't affect the mortgage interest rates, but the short-term capital typically affects the rates that people borrow from. Auto loans, some of these institutional backed hard money lenders that you might see out there, their interest rates have skyrocketed recently just because
Mm-hmm.
their cost of short-term capital has gone up a bunch. But in the
Yeah.
private sector, the private markets, it doesn't really impact it as much. I mean, a lot of it's just kind of risk based of like what type of return makes sense for us to get,
Mm-hmm.
in order to take the risk to lend out capital.
Okay. Well, I appreciate that. When I was investing heavily before I was doing building other businesses and so forth, um, I got to the point where I had borrowed so much and it was all good debt. I mean, I was always managing my ratios and I would just follow the bank's ratios. My asset to liability ratio, I never owed more than 2/3 of what I owned. Now there were periods of time where I was aggressively building, so I would go up to 80% leverage,
Sure.
but I would throughout the next year increase the values, raise the rents, and so as a result, I had that ratio. And then on the income expense side, my principal and interest was never more than a third of the my take home, and they included lenders will count any income you have coming in. It's not just your rental income; it's any income.
Yep.
So I was able to do that. But here's what I'm getting at, Jason. I don't know if this is common or you guys do this too, but I was at an apartment association meeting. These are like property managers and big investors. And there was a guy there who was a commercial broker, but also did private lending too, like your former boss. And we were sitting there talking, shooting the breeze, and he asked me about my portfolio, and I said, "Well, I'm at a point now where I had 30 units, so I was just getting started, but I didn't invest for a year because what I did is I took that year and paid down my secondary debt. Like I would use a home equity loan, I would use a personal line of credit, things like that. Well, I paid those down. And so now I was left with primary first mortgages. I'd increased my cash flow and I had more substantial equity. And he said, "Would you consider taking a loan out across your whole portfolio?" And I said, "Well, I'm not really interested because I've been approached with that and they wanted me to refinance everything. I don't want to refinance because I've already amortized them to a degree and got good rates." And he said, "No, I'll give you a blanket mortgage, a blanket business line of credit across your portfolio, leveraging your equity." And I said, "Really?" And he said, "Yes." And he gave it to me at 11%. And this was back in the late 90s where the banks were charging 8 and 9%. So I said, "You're
Yep.
going to let me do this for 11%?" He said, "Yeah." I said, "Sign me up, man." I went out there and bought the next property for cash, fixed it up, raised the rents, then put its own first mortgage on that, paid back the line of credit, and he increased it. So I'm like, this is it. This is my formula, man. So I don't know, is that typical, or do you have people that approach you with like, or is that even something you do or even advisable,
Yeah, I mean, I don't do that personally with our capital, but um, on a real estate portfolio that we've personally had in the past before we'd sold it about 2 years ago, we had something similar to that. And I think, the key word is creativity. Is figuring out kind of the best way to structure every single deal, what
Mhm.
fits best for you. And I mean, and also think about like leverage for what it is. Leverage is obviously a tool, and I feel like some people might be a little bit more aggressive than others based on whatever,
Mhm.
however you feel about it. But if you're trying to grow a portfolio, it's hard to grow a portfolio unless you really have leverage, right?
Right.
And in order to need that, I think one of the reasons why I was never a great real estate investor in general is I don't really like leverage all that much, and it scares me a little bit. And on the other side, I know a lot of real estate investors and developers, that they've signed on $50 million in debt, and to me that's scary. To them, it's like, well, this is the only way to do it. And every day I hit singles, and then on a regular basis they're hitting grand slams on some deals. I don't hit grand slams because I don't play in that. I don't play in that park.
Yeah.
And for better or worse, I mean, our whole business model and the way that we look at everything is kind of just slow and steady wins the race. And there's definitely some anxiety with that because it's like, hey, we're not playing in a space that you're just going to get these big bumps. But I know a lot of developers are hitting, huge, triples and home runs on a regular basis, and their net worth and their property portfolios are just skyrocketing. And hopefully they're disciplined, because what comes up, you hope ends up coming down. And in our model, like, I'm trying to build a machine that no matter what type of economic market we're in, what the interest rates do, things like that, just kind of continues to chug along. So I think it really kind of depends on who the individual person is. I mean, I know some real estate investors, their play is, I'm going to save up all my money from my hard work and buy one property in cash every year. And, that's just their play. And, they're trying to, whatever, make $1,000 extra per month. And at the end of the year, that's $12,000 extra, and do it that way. Now, I know some people that go all in really quick, some people that are slow. So I think it just depends on the threshold of what somebody's willing and comfortable with.
Well, it's funny. You've actually said something that's really, really important and profound. And I want everybody to listen to this. Is, Jason said he takes his singles. And if you think about it, and I know you guys know I'm a big sports nut, but when you look at baseball, right, and you study the game of baseball, that it's not all fun and games. It's a science too. And the teams that win the pennants are always good at getting people on base. They take their singles. They take the singles, and every now and then you get a double. Every so often you get a triple, and every now and then you get a home run. And if you're really having a good day, you get a grand slam home run. But you don't count on the grand slam home runs. You count on the singles. You get guys on base. At the end of the day, it's the classic tortoise and the hare race. I mean, at the end of the day, the rabbit's going to run out of gas, and the turtle's going to keep on chugging right along, and wins the race. So, and that was my story too. I mean, I didn't buy a big property. It was easily 10 years. I mean, big being, something over 50 units. I was just doing my, shingles, double, two duplexes, triplexes, fourplexes. And I was that guy, Larry, that did his company's called Briarcliff, that did that blanket mortgage. And he's retired now. But in any case, that's what allowed me to move into the 20 plus range. So let's go back to the bread and butter. So most of your properties, they're in the range, I'm guessing 100,000 into the hundreds of thousands. That's probably the sweet spot. And the thing that's important about this, guys, is that's where most of the properties are. So you're going into an area of the industry where you're going to find the most properties. You're going to always be able to get in the game, get on base, and keep running guys around the bases to score home runs, and not take on too much risk. I mean, think about it. If you got, let's say you're juggling 10 properties right now, or you're Jason, you're juggling 10 loans, and something goes sideways on one of them, you're still in the game.
Yeah.
You didn't put all your eggs in one basket. But so what does somebody go through? Because we got listeners all over the country, and a lot of them are, have used private money, they've used conventional bank money, and maybe some have even used hard money. But describe to them what that process is. What do you do when you get a hard money loan, and what kind of a transaction, an example or a case study that would help them see in their mind why they want to do this and when they would do it,
Sure. So, I mean, think about hard money, a little bit more complex, just a little bit more complex than private money, and a heck of a lot easier than bank money, right? So a private lender, typically it's like, hey, I know you, you know me, let's figure out a deal. Let's shake hands and let's do it. Right. And that's fine. That's a great source. But, in order to go find private capital, it could be hard. You got to go out there over and over and over and over, build relationships, do this, do that. Most of the investors might not have super deep pockets. So, hey, I'm doing 100,000 from this person and 100,000 from this person and $50,000 for this person. Different people have different personality types. And on a bank side, you've been through that. Tax returns, time frames, depending on what type of mood that they're in that particular day or environment. And, hard money is again, somewhere in between. So our process, is pretty darn easy. Typically, the first step is just reviewing the project with a potential client. There's no point to go out, to go meet at the property or to fill out loan applications or anything at this point. Let's get on the phone, have a quick conversation, and figure out what you're trying to accomplish. That's usually, the first step. Let's see if it makes sense. Is it in an area that we're comfortable lending in? Is it a project that makes sense? We follow what we call the 4 C's, so collateral, character, capacity, credit, in that order of importance, right? So it's got to be a good deal. I mean, I don't really want to do a loan for a real estate investor who's buying a crappy deal. Like, I want to help them in that case. If they're buying a deal for $200,000 and needs $100,000 worth of work, and it's worth $340 on the resale, and they're not going to make any money after it's all costs, there's no point. I'm not, I'm actually hurting you by lending you money doing it that way, right? Because the lender's going to be the only one making money on that deal, and that's not the position you want to be in. You'll never do it. Typically, real estate investors, if they lose money, like really lose money on their first deal, it's hard for them to do that second deal. And and a lot of the real estate investors and clients we work with have a repeat over and over and over and over and over, and that's the goal. So I want to make sure it's a win-win. But internally, besides kind of reviewing the deal together, the documents that we get are slim. A purchase contract, a ratified contract, title insurance, property insurance. We have an in-house property inspector that goes out to the properties that are local to us. The ones that are not local to us, we outsource to a few other inspectors that we're friends with, just to put our names on it. We're not getting physical appraisals and things like that. Yeah. I mean, honestly, not to talk bad about appraisals in general, but like, they don't have an economic interest in the project to begin with, number one. So I always want somebody internally inside our office that does have an economic interest to make that decision of what the value is. But then also, more importantly, like, 3 people could flip a house, or 3 people could buy a commercial building, and we'd all sell for different prices based on what we're trying to accomplish, right? Like, $100,000 construction reserve, a construction project that's going to be $100,000, like, that's a big project. Like, I will execute differently than you, and you're going to execute differently than a newer person. And someone who's done 100 properties in that neighborhood is going to execute the best, right? So that's one thing that it's hard to get a third party to just identify that. They don't know all the behind the scenes of what's going to happen. So we one of the reasons we only lend in a certain, personally, in a certain geographic area, is it's areas that we're comfortable with, and then we've learned or we've invested in over the years.
Right.
So we get an inspection, with some pictures and stuff like that internally, and that's it. Maybe one bank statement just to show they have enough cash into the deal, a scope of work, construction, renovation schedule, scope of work, but that's it. It's, again, some one-off scenarios. If it's a commercial building, we might get leases, and we'll do some sort of abbreviated environmental study, and things like that on some bigger commercial stuff. But a lot of these, they're collateral based. And yes, we do pull credit, because I do believe that, a real estate investor that, does have good credit and that does pay their bills, I do believe they will pay this bill. And we've also had challenges where real estate investors with lower credit scores with big construction projects have a hard time managing that construction project, and they end up defaulting. And if you're a real estate investor who wants to have a rental portfolio, I mean, I hate to say it, but like, you got to have good credit, because you're going to have to get a bank loan behind the scenes. Yeah. Like, unfortunately, if you're looking to buy a property to have it as a long-term rental, you're going to need either yourself or some sort of partner to come in with good credit. But our whole process on residential investment loans take a few days. Most loans, come in and on Monday, and a lot of them are foreclosure auctions or properties that have to close immediately. So they usually take less than a week, and commercial stuff typically takes 2 weeks, just because there's some additional due diligence, especially and we do this short form environmental that takes about 5 business days for us to get back.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto, okay? How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to GaryRealEstateWithGaryWilson.com. Click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Yeah. Well, I want to touch on the geography too. You mentioned you like to invest, lend money where you've invested yourself. And you and I both, we grew up there. So everybody listen, this is another critical thing to remember. There's lots of places in the US where you can invest. If you're from out of the country, we have all the websites that show you how to track money and people and all that. But if you look at that corridor between Washington, D.C. and Philadelphia, Baltimore is right smack in the middle. You've got a huge, massive population, mid-Atlantic population. I mean, just, and if you do a circle around Baltimore, go out to like Frederick, Maryland, which is maybe an hour to the west, and you've got Annapolis, kind of southeast. You got Wilmington, Delaware, and there's so many other cities and towns. Columbia, where I lived as a kid, also after I lived in Baltimore. I mean, I could spend a half hour naming all the towns around there that are great towns within that metroplex. You're never going to run out of opportunities. It's a proven market. The pricing is really favorable compared to some other markets around the country. I mean, try doing this in San Francisco or LA. I mean, you're looking at prices 10 times what we're used to in the mid-Atlantic. So it's good bread and butter. It's loading the basis. And so for people, we have listeners, Jason, from all over, mostly US based. But if someone was in like Chicago or Denver and they want to invest in that metroplex around Baltimore, can they do that with you, or if they're out of state, is that a big deal? Or
So that's a good question. So our company, Hard Money Bankers, operates mostly in the Mid-Atlantic region, but I actually run a mastermind group. It's called Hard Money Mastermind, and there's about close to 3,000 private lenders throughout the country that's in that group, and we have a few like higher level groups as well. And these folks have become friends. We've partnered on deals. We've co-invested on deals in different markets, and between that, and that's a smaller group, obviously. Between that group, they pretty much one person in almost every state in the United States. So that gave us the ability to, just straight refer deals from, a lot. There's local investors like you mentioned. There's local investors that might be in Maryland, but all of a sudden they've been buying properties in Florida or Georgia or Texas. And if I can't help them there, I'm happy to refer them to somebody else. And so pretty much, trying to think of any states that it excludes, but almost every state I know a private lender and or hard money lender. And typically when I say that, I mean these aren't like institutional companies that lend nationwide and using institutional backed capital. These are like one-off small businesses that have either gone out and raised capital through a fund to lend out locally, or they've used their own money and they're trying to to lend it out to one-off real estate investors on investment real estate or commercial real estate. So I definitely can help for almost any state in the country.
All right, awesome. Hey, let's talk about the properties. In that range, I'm sure you get people approaching you that do mainly flipping and others do mainly rentals. But do you have a preference or any? I mean, this is kind of a loaded question because there's probably going to be multiple answers. Like what have you done personally? Do you prefer long rentals versus flipping? I know you mentioned earlier flipping drove you crazy, and I will tell you, a lot of people I've seen start out flipping and fall off the horse the first time and never get back on because that's what they're seeing on TV. They're watching all these shows, flipping brothers, flip this house, flip flop, and and there's not one show on buying rentals, not one, probably because it bores us to tears. But let's face it, it's long term. So I mean, what do you prefer? But also, when it comes to lending, do you lend on both, or what's your protocol there?
Good question. I'll go through my personal stuff and then the lending stuff. So started out flipping houses, did probably a few dozen of them, didn't love it. Started acquiring some rentals.
Mhm.
Had a full-time, even had a full-time property manager in my office here. I'm gonna get back to the rentals in a second because there's a
Mhm.
gap between that. About 8 years ago, we were lending money to a pretty well-off real estate investor locally, and we created a venture where he said, "You know what? Instead of us just lending you money, why don't we do a partnership on that?" And we
Mhm.
started buying flips again, and
Mhm.
so we started buying flips that way. So that got us back into the game. I didn't like it any better than I liked it the first time, right? I like being the lender because I like the predictable returns.
Yeah.
And it's like, hey, there were some deals we made a lot of money, some deals we didn't make any money on it. And it's like,
Mhm.
hey, I just want my rate of return and I'm happy. I hope you make
Right.
100 grand and I only make 10 grand, but as long as it's predictable, I'm happy with that. And then
Yeah.
we had about 25 rentals, mostly single family rentals. And it was right around COVID or the year after COVID, we sold all of those rentals. In hindsight,
Mhm.
we sold them at the wrong time, but that's
Yeah.
fine. We I didn't like, even though I had a full-time person running those, I still didn't like it. I felt bad that she had to wake up in the middle of the night to take calls. I felt bad,
Right.
I hated that you know, hey, we have a $5,000 new roof that has to get installed. One thing I learned about rental properties in general, and I think that a lot of people might fall into this trap. And if you can avoid this up front, you'll be in a better spot. Is rental properties have to, like, capital improvements on rental properties can put some of these rental properties out of business, and they don't see that in
Yeah.
real time. If they're not saving for it, because it's 5 to 8 years down the road, sometimes 10 years down the road. And there's good amount of wear and tear on rental properties in
Oh
general.
yeah.
Half of ours were Section 8, half of ours were retail tenants. And we were at the point where we had fully renovated houses. We had them on the rental market. They were all rented. And then we were year 5, going on to year 8. And we're like, you know what? As these things turn over, there's $30,000 we got to plop right back into these things over and over and over.
Right.
And we had a good bit of equity. So that was our reasoning for selling them. And I also have an investment machine, a vehicle, because I can lend out that capital through my hard money
Yeah.
lending company. So that helped us do that. Um, but I think that's one, real tip that a lot of real estate investors that buy rental properties, they fall into that trap. They're like, hey, I'm making, $300 per unit cash flow. That's great. But,
Mhm.
like, you got to take into consideration that you're going to have big chunks of capital outlay that's going to happen, that starts occurring year 5. So
Yeah.
our current focus on assets that we own are through limited partnerships on commercial buildings, on bigger buildings,
Okay.
self-storage, office, and multifamily typically. So that's where a lot of our allocated capital is, with trusted partners slash, people that are friends with us at this point. So
Mhm.
that's kind of where we invest in real estate and get the depreciation and all the benefits of owning real estate. We get it through limited
Yeah.
partnerships. So that's what works for us. I'm not saying that works for everybody. And that's also not like a huge growth model either. That's kind of a longer term approach. On the lending
Correct.
side, on the lending side, we're like 50-50. 50% of our lending portfolio is for real estate investors that are fixing and flipping houses or flipping
Mhm.
properties, and then they rent it out, and then they pay us off with one of those, like, rental 30 programs, if you've heard of that,
Mhm.
or DSCR loan,
Yep.
where they,
Mhm.
our interest rates are, 12.99%. So these real estate investors don't want to hold that on forever. So they want to get in and out. They use us for short-term capital, and then they find a
Yep.
long-term rental lender. So half of it's fix and flip, half of it's what I like to call small balance commercial lending. So
Yep.
anywhere from 50,000 to 2.5 to $3 million for a small professional office, a little retail center, mixed use building, self storage property, industrial building, things like that. So we do a lot of smaller commercial stuff, and there's a huge need and demand for that. And I'm sure
Yeah.
if you've been involved in that space, that, like, banks don't really want to mess with that smaller stuff.
Yep.
It's not. I don't want to say it's not as safe, because I believe that the way that we structure the deals, it's safe for us. But banks want to get in deals with long term tenants,
Yep.
multi unit commercial buildings with longer term leases, longer term tenants. They don't want to, like, they're not doing a vacant commercial building. I lent on a vacant commercial building this past week in Washington, D.C. And on paper, someone might think that, oh, there's a lot of risk in that deal,
Mm-hmm.
from the surface. But our thoughts were the guy bought it for $850,000 in cash last year, because he
Mm-hmm.
bought it at a good opportunity. And this year he needed a loan of 300 grand just to rent it or renovate it so he could get it leased up. And he's got a high cash flowing business right next door that he owns that building as
Mm-hmm.
well that can support this debt. So to us, good credit, good financials, stuff like that. So it made a lot of sense for us. But
Yeah.
unfortunately, that project wasn't bankable for, when he tried to go that route.
Yeah. You're right. The conventional lenders are far, far more strict, and they're they make a lot of money on fees, and they also make the money because they amortize our loans. So most of the payments you're making is all interest, anyways. You're making very little principal, you know, payments on those conventional loans, and because a lot of our borrowing is short term. So typical example. I know we're going to get short on time here in a minute, but I want to kind of let people know, give them an idea of why this is so important, why they should be able to use this in their investing. Is, I guess, typical example, somebody wants to either flip a property or buy a rental that they see they're buying it. It's a value add. They're buying it, below market value. They're going to use the BRRRR method, right? Buy, remodel, rent, refinance. Are you financing the whole thing, less the investor's own contribution, or are you participating sometimes, like they're getting money from, it could be another bank or their Uncle Bob? But what's like your typical arrangement? Temporary for a year for a flip or a rental, then they go refinance doing the BRRRR method, and then you get your money back that way. Is that sort of
Yeah.
your bread and butter?
Yeah. So typically what we'll do is we'll lend like 80% of their purchase money and 100% of their construction costs. Because
Okay.
so easy math, they buy it for $100,000, and it needs $30,000 in work. We'll give them, 80,000 towards the purchase, 30,000 towards the work. So 110,000 total. So it's 110 gross loan. We hold back the $30,000 towards the construction reserve. As they start the work and continue to work, we reimburse them that $30,000. And they're
Yep.
making monthly payments. It is an interest only loan. So they're only making minimum interest payments. And, for the most part, as monthly payments are being made, let's say they refinance with the bank in 6 months after the property's renovated and they put a tenant in there, they owe us the 110 principal back because they're paying interest in real time.
Yep.
So it's a pretty simple process.
And now, what about the valuations? Are you looking at as is value, and then you're also looking at after repair value? And so what kind of spread are you looking at on after repair value? I mean, I know for us it was always 30%. We didn't always get it, but that was what we shot for. Is that, you're doing sort of the same thing, or?
Yeah, so we try to be at 65% of the after repair value. So we have 35% equity
Gotcha.
cushion. So,
Yep.
as a lender, and I think if somebody listening has never been on the lending side, you might not realize this, but as the lender, their risk is at the beginning. Their risk is day one. Like if I do a loan
Mhm.
and the real estate investor walks away from that project, depending on what state they're in, it's hard to secure
Yeah.
that property and foreclose on that property. Some states are obviously easier than others, but like our risk is day one. And keep in mind, there's nothing worse than having a vacant property because that thing could go down in value and potentially depreciate as, there's a lot of deferred maintenance that comes in, especially if, bad weather comes, vandalism, theft, things like that. So that property might only need $30,000 or $40,000 in renovation. But like, if let's say no work gets done and it takes me a year to get that property back, who knows what the renovation cost could be. Plus, being responsible for the taxes and property insurance and things like that. So most hard money lenders and private lenders, like they have a lot of their risk is kind of on the front end. And that's why they want to lend to clients and real estate investors that have good character and have the capacity and the ability to make the deals work. Because after the property is completely renovated, assuming that, you did a halfway decent job of renovation, that's when the property skyrockets in value. Is you go
Yeah.
from an as-is property, you renovate it, and it's a beautiful, nicely renovated property, and it's on the market. That's when the lender's risks go down a ton. But at the beginning,
Yeah.
getting the real estate investor to execute and get things done, that's when it's challenging. And we all know that, even the best real estate investors, they still go over budget. They still have contractors
Yep.
that actually steal money from them. They still have violations. Even if you have the best, work ethic and the best intentions, stuff just happens. Like things
Yeah.
happen. There's a lot of things can't control. We've had really funky weather in a lot of areas of the country. Insurance costs have gone up
Yeah.
significantly. I mean, there's a lot
Oh
of
yeah.
lenders. There's a lot of lenders in Florida, for instance, that are underinsured on replacement costs and things like that because they can't get the
Mhm.
insurance. So as a lender, they just have to make a risk, either a judgment call. Am I willing to take the risk on this particular deal? So like there's
Right.
things behind the scenes that I think a lot of real estate developers and real estate investors just don't necessarily see.
Yeah. Yeah. It's interesting. Interest rates have gone up all over the country, and it's not so I know I'm going to make people mad when I say this, but you could be in one of the, as far as the climate goes, one of the most temperate places in the country with the fewest problems. You don't have tornadoes, you don't have hurricanes, you don't have massive snowstorms, and you don't have a lot of flooding. But you know what? Your rates probably went up too because the insurance industry is trying to spread that across all the consumer base. So don't get mad
100%.
about it. It's just part of being in business and owning a home. I know people who's had variable rate mortgages. Their rates are going up, and at the same time their insurance went up, so their mortgage payments went from like 1,400 a month to 2,000 a month. I mean, almost overnight.
Yeah.
But you know what? At the end of the day, I'd rather own the property. One of our famous sayings is, and it comes from the fact that people will say, I'm going to wait and buy. I'm going to wait till the market goes down. I'm going to wait for this, wait for that, wait till the rates go down. The real way to look at it is buy and wait. Just
Yeah.
secure some property, sit on a log. I promise you, I'm old enough. I'm telling you, they're going to go up in value. You're going to have your mortgages paid down. And if you have 15-year mortgages, 15 years, you're going to be sitting on a gold mine. You just got to get through it. It's a game of patience and discipline. And you have to really, I'll give one quick tip here. We're going to try to wrap this up. You talked about the contractors, and I'm not going to knock them because we need them in our business. But one thing I learned to do is this: a lot of them want you to pay them on Fridays. I learned to not do that. I would say, no, my policy is I'm going to pay you on Mondays. So I don't care if the Ravens and the Steelers are playing football on a Sunday. I knew my guys were going to show up Monday morning, because they want to get paid. So, and
That's
I've
a
always
good
controlled
point.
the supply costs. I would say, I would go and look at the receipts. I look at everything, and I would catch people trying to cheat by trying to buy 4x4s for some other job building a deck when I'm putting in a kitchen. I'm like, come on, I'm not stupid. So I
Yeah.
would control the supply costs, and that really helped. Those two things helped a lot. But let's get back to you. So you mentioned a podcast. I mean, you mentioned your mastermind. I understand you got a podcast too. Would you mind letting people know what the podcast are and the mastermind group again, and we can
Yeah.
wrap it up with the website?
Yeah, absolutely. We actually have two podcasts, two completely different audiences, and two things that I concentrate on a regular basis. So number one, for real estate investors, our podcast is Real Estate Reserve Podcast. So Real Estate Reserve Podcast, I do it with a friend of mine, Ian, who was on the show with Gary as well. And
Yep.
in essence, I'm the lender side. He's the developer side. He owns a lot of real estate, single family houses, multifamily, everything like that. So we're a good team
Yep.
of expertise on that side. And the other side is a podcast called the Private Lenders Podcast, and that's geared for private lenders or folks that own hard money companies, or they want to deploy their own capital,
Okay.
themselves responsibly.
Okay, cool. And then the website is Hard Money Bankers with an S,
Yep,
bankers.com.
hardmoneybankers.com. Anywhere you
Okay.
search the hashtag Hard Money Bankers, that's been our brand. We were fortunate enough and lucky enough to get that brand when we started. I think we bought the domain maybe 05, 06, and then
Oh yeah.
started in 07. So everything we do is through Hard Money Bankers.
Yeah. Well, hey, you look pretty good for having started in 2000. That's like almost 20 years ago. So I'm guessing you started when you were in high school or something, right? No, just
Started when I
kidding.
was in my I started in my late 20s, and that's a different conversation related to a different topic of how the heck did you guys start with no capital out of your own, and you went to raise like $50 million that we lend out,
Yeah.
from folks, from investors, of folks that we
Well,
did not know at the time.
I'm sure it had to do with a couple of things. One of them being that you literally you just one base hit at a time, one property at a time, one loan at a time, and building a reputation. That's so vital. People always want the shortcut, including me. And I'm
Yeah.
telling you, the best approach is, the steady discipline, follow your model, don't go outside your lane, stick with what you do and what you know. And I promise you the world will reward you. So, um, recap. So you got real estate reserve, that's for the investors. So that's most of us listening here. Uh, Podcast, private lender podcast. That's for anybody if somebody's interested in learning about private lending, can they come on to that and just listen
Yeah.
the mastermind and join up and
Yeah. It's a free
okay,
mastermind. Hard money. I mean, that's somewhat of a passion project for us because there
okay,
was no education of how to start a hard money lending company when we started.
yeah,
I
yeah,
reached out to every, in essence, like older attorney in Baltimore area who was lending out their own money. That was the exact demo.
yeah,
They were older male attorneys. Those are the only ones. And then you have these kids in their 20s
yeah,
that want to learn how to do it. And I'd have to take them out to lunch. And this is pre-YouTube and things like that. And we
yeah,
were ambitious. And now obviously it's a different industry, institutional
yeah,
capitals in this space and things like that. But
yeah,
I like talking to a lot of hard money lenders, and most of them were a few years ahead of. So it's great to give them the shortcuts and the knowledge, because instead of them
yep,
having to learn the hard way on some of these things, pick up the phone and call me, or let's chat inside the mastermind group, and I'll give you the
yeah.
answer. I'll tell you what the future is going to hold for you on
Oh yeah.
the outcomes of some of these deals.
I, I love masterminds. And then the website, hardmoneybankers.com. So
That's
everybody
right.
listening, write this stuff down, reach out to Jason Balin. Is in the Maryland area. So it couldn't be in a better place to invest in. And Jason, thank you again for participating and doing this. And everybody listening, please leave a review for this. It's easy to do. It doesn't cost anything. It's that your reviews are what make our podcast go around. That's like the currency of podcasts. So we really appreciate it when you do that. And it helps a lot. So do that. Go to hardmoneybankers.com. Reach out to Jason. And if you're an investor, or if you want to lend it, you want to be a lender, or you are a private lender, join that mastermind group. You're all over the country. You got 3,000 people. I mean, you can't go wrong with that. So, guys, take care of yourselves. We will see you on the next Massive Passive Cash Flow podcast. In the meantime, take care, and God bless you and your families.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.